Hello and welcome everyone. So in today's video, we are going to talk to you about a very important aspect of your investment journey into the markets, and that is market corrections. Market corrections, will happen and do happen all the time. But if you're new to the market, sometimes you might get concerned and you might have excessive amount of worry about, a impending correction or, market peaking out and things like that. But if you are a mature investor or if you have, studied the stock market deeply, you would appreciate that corrections are part of the process and it is nothing but the market resetting itself for a little while before it reboots and start with a new phase. So a correction in the market is defined as a more than 10%, you know, correction from a peak, right? So if the market corrects by 10%, that is what you call correction. Any smaller correction is not called like a correction in the market. That's like a temporary blip. Now, these corrections can happen based on a number of reasons, right? It could be a geopolitical concern. It could be a monetary policy, could be something political that happens in the country. It could be some sectoral events or, valuation concerns. Or it could just be, you could not find a reason for when the correction happens because it was just, the valuation correcting itself. So corrections are an extremely important part of the market and, they are nothing to be worried about, but to be looked at as ways in which the market resets itself and then reboots to start. For a small cap investor, who's investing into smaller companies, the corrections can sometimes be much more pronounced, right? The smaller stocks, because of their size, tend to grow at a much rapid pace when money comes into them, and again they fall at a rapider pace because money is going out of them. So, as a small cap investor, if you have invested into the small caps right now, expecting the growth to happen, if there is a correction, you might see that pain. But what you have to understand is that small caps, most of them are, amazing companies that will end up having a good future, and any short term correction that is not because of any concern about the particular companies or their corporate governance will tend to be temporary, and the companies, small cap company, you know usually come back up much faster from a correction than the large cap peers. And talking about small caps, we've seen an amazing rally happen in the small cap sector. You would see most of the small cap funds have received a lot of investor interest, and the small cap index has beaten the large and mid cap index by a good margin. The Nifty small cap index has given 20% return in the past 3 months and 32% returns in the past 6 months. If you compare this with the large caps have hardly given a 2 to 3% return in the last 3 months, whereas in the last 6 months, they've given an 18% return. The stocks in the small cap segment, which have been getting the most amount of momentum, have been from the investment theme, right? So that includes capital goods, defense, railways, EMS, real estate, and renewables. And these sectors or industries have seen a tremendous rally happening in the market in the past 6 months. If you now look at the number of the interest that these small cap funds are getting, you should look at the number of folios that are being created for the mid cap, small cap, and large cap segments in the last 2 months. You will see that the small caps funds have seen a massive increase in the number of folios, whereas the growth in mid and large cap has been much slower. Again, there has been a tremendous interest from retail investors into the small cap segment. The primary driver of this rally seems to be, the exuberance from the investors and the extreme interest that they have been showing for these small cap stocks that are right now giving them a good return on their capital. On the table on your screen, you will see that while large and flexi cap, large mid caps have seen a slowdown in growth in terms of inflows in the past few months, small and mid cap funds have seen a lot of interest, and this is just mutual fund data. If you look at other avenues, which is how investors invest via advisors, you will see that in fact has also seen a tremendous amount of interest, especially in platforms like small. So where are these investors putting in their money? So traditionally, if you look at the small cap trends, you will see that the consumption theme, which includes sectors like autos, FMCG, consumer goods, has been a favorite of small cap investors. But this time we are seeing a tremendous rally happening in mid and small cap segments, which are in the investment theme, which includes capital goods, defense, EMS, railways, real estate, and renewables. So these are in the new India themes or the themes that have been getting a lot of capital investment from the government as well as from the industry. And if you look at the returns on your screen, you will see that the valuation of many of these companies in the investment theme have increased quite rapidly over the past few months, and that has been a concern for some investors. So investors that we talk to always have this concern that, okay, we're getting a very good return right now, but the stock has already rallied so much. Is the earning holding up? Or, have we gone into the overbought zones, and is there going to be a correction? And I think this tremendous rally has started bringing out that questions for the small cap
Let's
investors.
look at the historical perspective. Small caps generally tend to be more volatile than their large cap counterparts. And what this means is that the price trend, which goes upwards and downwards, that tends to be more exaggerated for small caps, right? So if you see this graph, let's try and break down what's happening during and after market corrections. During a correction, there are four things that are happening. One, higher volatility. Second, reduced liquidity. Third, earnings vulnerability. And fourth, reduced access to capital. Let's look at each one of these individually. So, in terms of higher volatility, small caps usually experience steeper declines than large caps during market corrections. And this is due to the inherent risk, lower liquidity, and the fact that more often than not, they are the first ones to be sold as investors seek to reduce the exposure to these very volatile assets. Let's look at the second point, reduced liquidity. In a downturn, there might be few buyers for small caps, which makes it very hard for investors to sell without ultimately affecting the stock price. And this reduces the liquidity that's available, which can exacerbate the price declines further. Third point, earnings vulnerability. Small caps might not have the financial strength or diversification that large cap companies possess, and therefore, any economic downturn can ultimately impact the earnings more severely, which will ultimately put a lot of pressure on the stock price as well. Fourth point, reduced access to capital. During corrections or recessions, capital markets can tighten, making it challenging for smaller companies to raise funds. This can be very problematic for those that are relying on external financing. Let's look at what happens after a correction. So there are three things. There is the potential for higher returns, there is a re-evaluation and maybe a strategy shift, and ultimately we need to consider what happens with investor sentiments. So let's go through them one by one. The first point, potential for higher returns. Historically, after a market downturn, small caps have shown the potential to rebound aggressively, and their lower base can allow for a larger percentage increase, which offers substantial returns for those who can endure this volatility that small caps ultimately give you. The second point, there is also a re-evaluation of the strategy, and ultimately there's a shift in the strategy. Post correction, many small cap companies tend to re-evaluate their business models, they streamline the operations, there's a lot of cost cutting that happens, and this ultimately makes them more efficient and maybe even more profitable if we look at it in the long run perspective, right? The third point here, investor sentiment. This is very crucial. As the market starts recovering and the sentiment and the confidence that investors have, that improves, investors may start searching for better and higher growth opportunities, which ultimately leads them back to these small cap stocks where there can be this renewed interest, which can maybe boost the small cap stocks
If
price.
we end up seeing a correction in this market, what could be the reasons for it? And what are the reasons which are causing a worry among investors for a impending correction? So some of the reasons are number one, like we discussed, the valuation of small caps are at a high, right? The prices have run up so much that people think that the earnings or the real value of the stock will not be able to catch up to that, and that's why they expect a correction. There has been a lot of optimism, right? Obviously, we've got good returns and we want to continue getting those good returns. The optimism is very high and the valuation have sort of reached a higher number. Now, the second concern that investors have had from the market is inflation, right? So inflation did ease a little bit in August, but in July we saw that inflation peaked in India and those numbers were a little scary. If inflation is high, then the consumer's spending power goes down. There are a lot of impacts on revenues on companies in the consumer sector. And that might bring down the rally, and that might lead to monetary action which will impact the market. Similarly, in the US, the inflation has again risen a bit in August. And if inflation rises in the US, you will see that the rates will not come down. There will be implications for monetary policy, and monetary policy has a direct impact on the stock market, be it from the US or from India, right? So anytime the government raises rates, it has a direct impact on companies' earnings, and that impacts the stock market. Another big concern that people have had is the fear of a global recession. The global recession, has been a concern on investors' mind for more than a year. With the high interest rates and the slowdown in the U.S. economy, people expect that the global markets could go into a recession. Obviously, such fear is not there in the Indian economy right now, but a global recession will have a direct impact on India and any industry that that depends on exports or services coming going out to foreign countries will also get a big impact, right? So a global recession is a fear that is playing around with people's mind that expects them to see a correction. Another big concern that is coming out right now is from the crude prices. The OPEC nations, the Saudi oil authority has sort of said that they are going to keep on keeping the supply constrained, which will lead to crude oil prices rising. If crude oil prices rise, countries like India, which import crude, and even global markets that are whose economy is totally dependent on crude, will see huge impacts, right? So inching up crude prices could be a spoil sport for our markets, and that is another concern that investors have when they look at the current market. As per our understanding, a stock market correction is nothing but the market resetting itself, and some of the highly valued stocks correcting and the opportunity coming back to stocks that are undervalued. So right now, if there was to be a sector rotation, which sectors should get an allocation in your portfolio? So the first theme that we're looking at is the high inflation and rising crude price theme, right? So if we see that the inflation rises and the crude prices rise, you will see the energy stocks, right? Stocks that are in the OMC, in the gas exploration, refinery, and distribution will stand to gain. Secondly, with the concerns coming out of China, the metal sector itself could be a big gainer in this sector rotation. From the inflation theme, if you were to avoid something, I would say to avoid those stocks that will be hit by high inflation but are at a high valuation right now. Now, the second theme where you could see investment coming in is the domestic theme, which gains from the festive season, right, or consumption. So here you will see companies in the FMCG sector which will gain a lot from the upcoming festive season. PSU banks, right, which will gain their credit during the festive season. IT, which is gaining, in the domestic market, the digital transformation is giving so much opportunity to the IT sector, so that will also stand to gain. You will see pharma getting, some allocation, and pharma is actually uh, performing very strongly in the market right now, so that would be one such sector. The global supply chains are being impacted, and that is sort of giving a boost to the chemical sector, which is at a bottom, so that could be getting some allocation. And lastly, cement. So with all the infrastructure industries growing, the material which will be used, which will be cement, will also end up gaining a lot. Now, talking about the theme of the global recession. So if a global recession ends up happening, which stocks or sectors will get allocation? So obviously, when nothing works in the Indian market and you can see that analysis, you see that IT industry in India as well as pharma, stands as the only gainers, right? So if you remember early this week, we had a correction in the market, and the only sectors that stood positive during that time were IT and pharma. So if such correction happens because for global recession, IT and pharma should be on your radar. Now talking about sector rotation due to the high valuation concerns, right? So the sectors that would be favorable right now would be IT, PSU banks, cement, chemicals, which are at the undervalued stage. And on the other hand, what would be stock that you could avoid or be careful with are stocks that have reached a very high valuation which their earnings are not able to justify.
Managing emotions during market corrections is crucial, right? There is the behavioral and the emotional aspect that comes with investing, and this is especially important when we start considering what's happening in a market correction scenario. There are 3 points that I want you to remember here. The first point is that there is the psychological aspect of investing. The second point is avoiding panic selling, and the third point that I really want you to sort of think about is recognizing the danger and the temptation to time the market in specifically in these scenarios, right? So let's go through each one of them individually. The first aspect that we spoke about was the psychological aspects of investing. Stock market investments are not just numbers on the screen that we sort of look at. They often carry a lot of weight in terms of the hopes and the dreams and the aspiration that all of us have when we are investing in the market. We all want our wealth to grow, and there is this obviously a very personal attachment to the investing that we're doing, and that can have a very, very profound effect when we start considering the emotional ramifications and the emotional reactions that we have to a lot of these market movements that are happening out there. Herd mentality. Watching others panic sell can create an infectious environment of fear. The natural instinct here as humans is to follow the crowd, right? But this can obviously lead investors astray. Overconfidence. There are periods of bullish markets and there will be periods of bearish markets. The market is cyclical in nature. However, bullish markets can give this false sense of security, invincibility, this sort of overconfidence that every decision that you're making will have a positive impact on your portfolio and that the stock will always continue to rise in the future as well. There are unwarranted blips and challenges that every stock market or every investor faces, and that is something that we all need to be very, very watchful and mindful. Second main point we want to make here is avoiding panic selling, right? There is obviously this historical perspective where, like we discussed earlier, corrections are a natural part of the market cycle. Markets will move up and markets will move down. Historically speaking, every market dip was always followed by a recovery, right? And that is why when you look at these long-term trends, the trend has always been on a growing horizon, but there will always be these periods of dips and increases in the market. We need to be aware of the longer term vision that we have for our investments and for what is the investing strategy that we're following here, right? And these short term market movements, those are just short term in nature and not necessarily going to deter your long term vision. Avoid drowning in the noise. There can be a lot of negative noise coming out, specifically in these market correction environments. And it is important to distinguish between factual updates and what is an opinion-driven commentary of where the market is headed. The third main point that we made was on recognizing the danger of attempting to time the market. This is very, very crucial, right? Market movements are influenced by a lot of factors, and a lot of them are very unpredictable. It is very, very difficult to time the market. It is always better to have time in the market rather than timing the market. It's always crucial to have a consistent strategy. If you are, instead of timing the market, if you follow a consistent, very disciplined approach where you are following, let's say, a rupee cost averaging mechanism or a SIP model, you follow and invest in regular periods, you invest according to your longer term vision, irrespective of how the market is performing, then that can yield better results, specifically when you're looking at it on a longer term horizon. Market corrections can be challenging, and it serves as a very, very opportune time for you to look at and reevaluate some of the strategies that you're using when you are investing in the market. First point, rupee cost or dollar cost averaging. This involves investing a fixed amount of money at regular intervals over a period of time, regardless of whether the market is up or whether the market is down. This method ultimately allows investors to basically buy more shares when the prices are down or the market is low, and when the market is a little high, then you're buying at a higher price, and therefore you're going to get a fewer stocks. But in terms of the performance, in terms of the longer term view, you're going to be averaging out your buying price over a period of time, right? And what it does is it ultimately mitigates the risk of timing the market. By taking this consistent and very disciplined approach, you can alleviate any stress that might come with deciding and trying to figure out when to time the market and when to enter and exit out of the market, right? So what this does is it provides this very disciplined approach, and there is no emotional bias that comes into this decision making. Second point that we discussed was on diversifying and rebalancing the portfolio, right? And what this means is, through diversification, we are obviously spreading investments across different asset classes, across different securities and sectors, and you don't want to be exposing yourself to any one single risk factor that's out there. And this strategy can obviously help you limit your losses, and during corrections, it can definitely ensure that your eggs are not all in one basket and your asset classes are not moving in tandem with the market, right? If the market is falling, not all of your assets are going to fall together with it, which is why you should obviously not just invest in equity markets. You should also look at a lot of other asset classes that are out there as well. You can do to really evaluate how your portfolio is performing, and you should do this on a regular and a very periodic basis. It could be that your risk tolerance has changed. It could be that the goals that you were considering have changed. And a lot of that will have an impact on how you change the asset allocation of your portfolio. Can consider making these tactical moves or very strategic shifts based on what's happening in the market, right? So you can take this approach of most of your portfolio remains very steady and stable, but for a part of your portfolio, for a very small chunk, you can try and see if there are better conditions in the market. So if the market is down, you could consider buying into it. If the market is high, you could consider selling out of it, which can help still stabilize your long-term performance of the portfolio. Finally, this brings us to our last point, which is on the long-term view. Historically speaking, markets have recovered from corrections, and ultimately it's a matter of patience. A long-term perspective does provide you this view of that these corrections are temporary. When considering a long-term view, obviously consider what your goals are, look at your retirement plan, look at what investment objectives you're looking at on the 10, 15, 20-year horizon, and then try and figure out if the way that your portfolio is performing and how it's doing across these market cycles is appropriate. And ultimately, what you should do 100% is to obviously avoid the short-term noise. There is a lot of news, a lot of predictions, a lot of market-ending worries that are out there. We should always look at that. Information is crucial, but it's also very equally important to be very aware that a lot of this is very momentary noise and it happens on a short-term basis and not, let's say, on a long-term basis. There are a lot of opportunities that can come in market corrections, and this is especially important when you're looking at it from the perspective of a long-term investor, right? Because you will see a lot of downturns in this long-term view that you've taken, and there will be a lot of valuable opportunities that we can look at. So let's look at some of these few points that we can consider here. So we'll talk about two things. The first is the potential to buy quality assets at potentially discounted rates, and the second is identifying fundamentally strong securities, or let's say small caps in this case, which could rebound and perform better in the long corrections. We often see blue chip companies, small caps, a lot of different classes typically falling and having a shock in their stock prices. And this is typically a very good time to look at these very blue chip companies that are doing well, have historically always performed well, and that is the right time to sort of enter the market and see if it can be bought at a relatively low cost. Investors who typically capitalize on this are obviously rewarded from a long-term perspective, as these stocks tend to perform well. Another opportunity here could be bargain hunting. You could go out into the market and see companies that have got strong fundamentals, have been performing well, have strong profit numbers, good cash flow out there, relatively low debt. Those type of companies you could consider and look at buying these good stocks at relatively discounted prices, given that there is this correction that has happened in the market. And finally, obviously, there are dividend yield paying stocks. You could buy those at reduced prices, which could improve the yield from these stocks, given that there is a dividend component attached to it as well. And this dividend typically is inversely proportional to the price of the stock. You can identify fundamentally strong small caps that are doing well, have done well historically, may have good fundamentals, and are likely to rebound and do better in the future as well. Small cap stocks obviously have this volatility built into them. We all know how volatile small cap stocks can be, and in market corrections they tend to sort of be more volatile. But what this also does is it presents an opportunity in the recovery phases for them to perform better, because they're not just volatile in downturns, but they're also volatile when the markets are doing well. So they have the tendency to outperform and do better than what the market is giving us. And what it all really boils down to is having a strong research, strong analysis of what is happening in the market, how these small cap stocks are performing, really analyzing them at a fundamental level and seeing if it is the right stock for your portfolio, and whether it has the opportunity to outperform and do better across economic cycles as well. And finally, obviously, there is this opportunity from a higher return potential. Historically speaking, small cap stocks have outperformed broader market corrections. They've also outperformed their larger peers typically, but they also come with higher risks, right? So we all need to be aware of that. And corrections can also shine a light on maybe specific sectors that you may have been looking at, which may have been unduly punished by this entire market falling or a market crashing. And if you have a long-term view that a specific sector might be doing well, that could be a right time to sort of enter that space as well.
Wright Research, your advisor that has been there with you in the market for the last 4 years, and that comes with a wealth of experience in the market, is not worried about market corrections. We look at market correction as an opportunity to practice our risk management as well as to look at new opportunities that will be more suitable for the next cycle. And at Right Research, we do have a number of ways through which we reduce the investor's risk. And there are multiple layers to it. So the first layer is diversification. If you invest into any of our portfolios, be it momentum portfolio, which has 20 stocks, or alpha, which has 10 stocks, you will see that both of these portfolios, or all of our portfolios, in fact, include a number of subsectors in industries. Even alpha with 10 stocks ends up having, 10 different industries. So diversification is something that we put a big focus on, and that is the first layer of protection that we offer to investors. Second layer of protection is what we do in terms of asset allocation. So for some of our strategies like the balanced multi-factor, we have a layer of asset allocation. What that means is that when you go through a correction, or when you go through a risky market scenario, we bring in other asset classes, right, like gold, bonds, to reduce the risk, and that helps investors in their risk management journey. So asset allocation, which increases diversification for the portfolio, is the second layer of risk management that Wright Research offers. Now, the third layer of risk management from Wright Research is something that we talk a lot about, right? Which is understanding the regimes in the market. What we truly believe, and what I think a lot of investors truly believe across the globe, from Jim Simons to a lot of people in India, is that the market does not remain the same all the time. The market goes through multiple regimes. In certain regimes, you see that the market ends up being very, very strong, or it goes through a bullish phase and investing in momentum makes a lot of sense. But in other regimes, the market goes through a bearish phase, some sort of a correction, or sometimes even a crash, right? So our idea at Right Research is that we want to tailor make our strategy not just for one regime, but for the different types of regimes that we see in the market. So regime modeling, where we use macroeconomic data, where we use technical data, and where we use forecasting or AI-based models to forecast, how will the risk look like for the market in the next period, becomes extremely important, right? So regime modeling is present in all of our strategies, from alpha to momentum to any other strategy that you're looking at. And in when the market goes towards a risky regime or any sort of correction, you will see that within all of these strategies we start reducing the risk and catering to the new regime that is coming up into the market. So that becomes another layer of protection that your portfolios at Right Research have. Now, the last layer of protection, which is uh, the overbearing layer that we have on all our strategies, is the deallocation policy, right? So what happens is that even though we have created our strategies for the good markets as well as the bad markets, when a sharp correction happens, it is easy. It is it makes sense to put all your risk management caps on and becomes aggressively in capital preservation. So we do have a systematic deallocation policy. What that means is that with every 5% correction in the strategy, we start reducing our exposure to the markets by 5%, right? So we take out 5% of the money, put it into a liquid instrument or cash, so that your risk is reduced. And with another 5 correction will again reduce. And we do it in a systematic fashion, which is a little bit adaptable. It's not as simple as 5%, but it has adaptability
Market
element.
corrections are normal events for us when we're investing in the stock markets. And typically, with small caps, you will see them being hit harder, even if they have maybe a stronger growth potential once the market does recover. And in the current scenario, what we're seeing is that the high valuations in small caps, the inflation numbers that we're seeing right now, the global recession fears that were there earlier in the years, along with maybe oil prices also rising now, a lot of that has really had an impact on the current market conditions. But that doesn't mean that going forward, and certain sectors like, let's say, energy, metal, FMCG, pharma, these are all still offering good investment opportunities. Investors should ultimately look at managing their emotions and focus on the long term horizon and the long term goals that they have. They should use some of these market corrections as good opportunities to buy what good quality, high quality assets that are available in the market. And the way of doing this is obviously not just through tactically allocating your money in the market, but also following a disciplined approach, like we spoke about, such as rupee cost averaging, the SIP methodology, the diversification benefits that you can get through your portfolio, among others as well. And finally, at Wright Research, we deploy AI driven predictive analysis tools, dynamic asset allocation, and strategic deallocation to really build a risk management strategy that can work for all of us. And ultimately, while the landscape is changing and we're seeing this market correction happening for at least the small cap sector, the most important thing is to stay informed and really keep your emotions in check and ensure you're up following a very disciplined approach to investing here. Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to like this video and subscribe to the Right YouTube channel. We will be back with many more insights, reviews, and market updates in the coming weeks. Till then, click on the bell icon to stay tuned for more such amazing Right updates. Happy investing.